This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. This week, a special extended interview with Treasury Secretary Scott Bessent, fresh back from his G7 meeting in Banff, where the news was overshadowed by the House of Representatives passing that massive tax and spending bill, a cornerstone of President Trump's economic plan.
I think this bill is very important because, as I've said, our economic policies, Trump economic policy is really a three-legged stool. So it's trade, taxes, and deregulation. So this tax bill, first step, making it through the House, I think the permanence in the bill from 2017 is going to give, everyone's talking about, oh, there's not enough certainty now. Well, what I can tell you is this permanence is going to give great certainty. And I think the scoring, you and I have talked about it quite a bit, it's Washington-style scoring, and it's not real-world scoring. What I am concerned about, or have been concerned about, are we controlling expenses? Yes. Are we going to grow the economy and accelerate the economy and stabilize and then bring down the total debt to GDP? And I think this bill does a great job of that.
As you told us more than once, one of your goals is a deficit that's no greater than 3% of GDP. The scoring, the predictions on this bill as it's written right now is 7%, maybe 6.5% next year, not anything close to 3%. Now, you said we won't get there right away, but when will we get there?
Well, David, what I've talked about is something with a 3 in front of it by 2028. We didn't get here overnight. We're not going to get there tomorrow. But what we've got to do is change the trajectory and start moving it down. So, could we get down to 6%, something below there with a 5 handle? Because what the scoring doesn't include, we have substantial tariff income coming in, so that's not included. We have DOGE savings in the hundreds of billions, that's not included. And then President Trump has made this very bold proposal on prescription drug pricing, which could save HHS substantial amounts of money. So none of those are included. So I'm very optimistic.
So let's include those for a moment here and start with the first one that you identified, which is tariffs. We've had some announcements, even very recently, about tariffs, maybe 50% from EU and 25% on Apple products. Is that motivation for that revenue? I mean, do you need those tariffs actually to go into effect to meet the numbers you need in deficit?
Not at all, because we have substantial revenue coming in now, and there is, at some point, there's an equilibrium rate, what's called a Laffer curve for tariffs. And I think we will reach that rate. The other thing that's happening is a lot of, there are tariff barriers or non-tariff trade barriers. A lot of these non-tariff trade barriers are coming down. So friction's decreasing there. And again, because we don't know where these tariff negotiations are going to end up, they won't end up being scored, but it's several $100 million a year, several $100 billion a year of revenue that will be used. For every 100 billion, that's 100 billion less of bonds that Treasury has to issue.
When you talk about uncertainty and getting more certainty because of the tax bill, some of the uncertainty, a lot of it is because of tariffs right now, because we're not exactly sure where we're going to end up. Do you have a sense when the economic community, the business community, will get better certainty on tariffs?
Well, we've done the 90-day pause. As I've mentioned several times, we have 18 important trading partners. So what everyone should really focus on are those. We've done a deal with the UK. My sense is over the next couple of weeks, we're going to have several large deals announced. We have put a pause and a 90-day pause with China. I expect that we will be negotiating in person with them again. And then the president today, when we initiated the pause and the 10% are moving down from the April 2nd rate to the 10% level was contingent on countries or trading blocs coming and negotiating in good faith. And I think the president was getting frustrated with the EU. You know, the problem with EU, I've said several times, they have a collective action problem. There are 27 countries. They all have different needs. The Germans, they are interested in cars, the French in agriculture. So, and then you have Brussels negotiating with them. Now, I am very impressed. I met my German counterpart, who's part of the new German government, the German finance minister in Banff, that he was very responsive. I think that the new chancellor, Merz, is going to give an opportunity for a U.S.-Germany reset. So I'm very optimistic that perhaps Germany can help push the EU forward here.
Let's talk for a moment about something you know terribly well, have lived it in your professional life, which is the markets. The bond market hasn't necessarily stood up and applauded with what they've seen out of Congress. Is the bond market wrong?
Well, I think the notion that in any movements in the bond market are being driven by the action of Congress is what's wrong. First of all, this has been a global phenomenon. That the Japanese yields have moved substantially, German, UK, and David, if we go back and look, since either the beginning of the year or January 20th, when the Trump administration came in, the U.S. 10-year is the only yield that is lower today. So, all yields are up. And again, I think that that was a coincident indicator. The market's very good at latching on to a story. So I'm not particularly worried about what the market's thinking, because, on the other hand, what the market also could be thinking is that this bill is going to create growth.
One form of regulation that gets a lot of attention in New York and on Wall Street is banking regulation. Let's talk about the supplemental leverage ratio, which seems like an obscure thing off to the side, but it has been the subject of much discussion. And it does, as I understand it, relate to U.S. Treasuries and yields on U.S. Treasuries, so that if major banks held more U.S. Treasuries, it would bring yields down. You've said you're going to take more of an active role, as I understand it, with respect to some of that banking regulation. Where are we with that?
I think we are very close to moving the supplementary leverage ratio, SLR. That is moving along very quickly between the three banking regulators, the Fed, the OCC, and the FDIC. So I would think we could see something on that over the summer.
Over the summer. And knowing the markets as you do, would you anticipate that might have a significant material effect on Treasury yields?
Well, I think it could, because banks are being penalized for holding treasuries. There's a large supplementary leverage charge. So I think for holding the risk-free asset, we can reduce that. And I've seen estimates that it could bring yields down by tens of basis points. Certainly during the COVID crisis, it was the temporarily taken off, and it had a big effect.
Let me ask something different, but I think might be related, which is stablecoin. If really we went big into stablecoin in this country, what effect could that have on the strength of the dollar, because people might have to hold dollars in order to match against it, or even for treasuries?
Well, we are going big on digital assets. So Trump administration has made digital assets a priority. Past administration starved and almost made extinct a lot of these companies and pushed it offshore. So what we want to do is apply the highest U.S. regulatory and AML standards to digital assets, especially stable coins. And I've seen estimates that just over the short term, stable coins could create $2 trillion of demand for U.S. Treasuries and Treasury bills. To put that in context, the number is probably about $300 billion right now.
There are reports, including on Bloomberg, that there may be, if I can call it, privatization of Fannie Mae and Freddie Mac, something that's been talked about since I think they were nationalized, essentially, during the great financial crisis. I heard the president say, I'm going to ask Scott Bessent about this. So has he asked you, and where does that stand?
It is a goal for this administration. Again, we're doing peace deals, tax deals, trade deals. So as we land some of those deals, then we will focus on that. But David, what I can tell you, we are doing a great deal of studying at Treasury, because the one requirement for this privatization is that they are privatized in such a way that mortgage spreads do not widen. And in fact, is there a way that we could make the spread between the risk-free rate and mortgages tighten as the Fannie and Freddie are privatized?
That was exactly my question. So do you know the answer to the question? Is there a way to do that? Because most people are concerned that will drive up mortgage rates.
Sure. There are several ways to do it, and we're exploring it.
President Trump said a while ago, posted actually on social media, that they were in the process of removing the tax-exempt status from Harvard. There's been a lot of issues with Harvard, but that's one that comes within your bailiwick. Where is that process right now?
The president is moving forward with that. And we're also looking at taxes on endowments. And I think the important thing here, and it goes a little bit back to this Main Street versus the elites, that Harvard, to have a tax-exempt status, there are rules you have to follow. And if you're not following the rules, no one's above the law. So we will see if they're following the rules. It looks like there's a substantial number where perhaps they weren't. And, again, too, Harvard is a gigantic hedge fund. They run a leveraged investment model. So we'll see where all that goes.
Is it Harvard alone, or are there other universities or colleges that also might be subject to review on tax-exempt status?
I haven't seen that, but again, back to cutting government expenses. These things are more out of control. The universities, they are more out of control than the government. That there is a separate inflation index. It's called like the Index of Higher Education Inflation Index, and most of the expenses have grown at CPI plus 3%. So they need to get their houses in order.
Coming up, we continue our conversation with Secretary Bessent, focusing on his G7 meetings and how they fit with President Trump's new round of tariff announcements on Friday. The group of G7 finance ministers came away from their meeting in Canada united in their commitment to addressing what they called imbalances in the world economy. Secretary Bessent says that there's really one imbalance that brought them all together.
The group as a whole was very concerned about the global imbalances around China, that China just keeps increasing their share of global manufacturing and has not done a much needed adjustment in terms of consumption. And as I predicted, I normally don't like to take victory laps, but I did predict it, and I was right. I said when the U.S. put up the tariff wall, that all those Chinese goods would go somewhere, and I think the G6 has seen that these Chinese goods are starting to permeate into their economies. They're quite worried about it, but there's a whole series of global imbalances. We have a large trade deficit with the EU, so we'd like to see more pro-growth consumer spending there. And but the real thing, when I think about China and the rest of the world, especially the U.S. In the U.S., we are trying to rebalance towards more manufacturing, mostly high-end manufacturing, not the kind China has. Everyone agrees that China needs to rebalance toward less manufacturing, more consumption. And is there a chance that we could do it together? what Ray Dalio might call a big, beautiful rebalancing.
So as I understand it, I'm not a macroeconomist, as you know, but so as I understand it, when you have these trade imbalances, it means we're importing, buying more things, and we're exporting dollars, essentially, overseas. A lot of those dollars have been coming back to us in various forms, particularly in U.S. treasuries. Can you have a rebalancing, for example, with China, or with Europe for that matter, that doesn't necessarily raise the yield on treasuries because there are less dollars overseas to be invested in U.S. treasuries?
Oh, sure. I mean, these balances weren't always like this. In 2000, before the China shock, we've historically had big inflows into treasuries. But what used to happen was in the old days, trade would come in, and then we would sell the other country a GM. Now we are selling them either a treasury bond, private equity, or Google stock, and that has a lot of distributional problems within the U.S. So that's how we've ended up with the coast or Wall Street doing very well, middle of the country, manufacturing being gutted. So, I think it's the composition of the flows coming back in. And then, as you mentioned, I think we can see more bond buying by U.S. citizens, U.S. institutions. But the other thing that I will say is, I have access to the data, and we've actually been seeing foreign national entities, whether it's reserve managers, sovereign wealth funds, or pension funds, have been buying more treasuries in the latest auctions.
So when we talk about trade, we talk about goods, sometimes services. What about capital flows and how capital flows work? There seems to be a movement in parts of the world toward stopping capital flows. I mean, we've had Macron in France say Europe can make it on its own. We've had Australia take certain actions requiring pension plans to invest domestically. Are we moving toward autocracy?
I don't think we have to. There's certainly nothing the U.S. is doing to prevent capital flows. Except for strategic products, high value tech products. The rest, we want smooth capital flows globally. Could we see more people being more nationalistic? Maybe. But again, as we saw with these trillions of dollars from these Middle East countries coming into the U.S., the U.S. is the premier destination for capital. We are working to do everything we can on that. And David, back to your question on the money coming back into the bond market, that a lot of it's going to come back in the form of foreign direct investment, which is actually a much more stable kind of investing.
Let's talk about the dollar for a second and where the dollar is. I've seen some charts actually about the nominal value of the dollar versus purchasing power parity. And in fact, that there's been a growing difference between those, where the nominal value is well above PPP. I mean, almost at historical levels. From your experience with markets, does that have to correct itself? Does that mean the dollar's overvalued?
It doesn't have to mean it's overvalued, and lots of times that levels can stay, versus PPP, which is just an academic measure. Many currencies stay above their PPP equilibrium for a long period. And David, I can tell you that when I look at the amount of innovation going on in the U.S. vis-a-vis the rest of the world, everybody wants to come here.
So as you look forward, what is the thing that worries you the most?
That we are not able to, that somehow our agenda gets slowed down. When you ask me what worries me, is this, look, we need this substantial permitting reform, that we aren't able to build things, that we have, because of this AI boom, we're becoming the AI superpower. Well, that's going to take a lot of electricity. So you're going to need energy pipelines, you're going to need transmission. And the fact that that it takes 3, 6, 7 years for the permitting. So what worries me is that somehow we get bogged down in a legal morass, because this administration is really trying to get America back to building again.
One of the things that people are interested in is the sovereign wealth fund. I remember, actually, as I recall, seeing President Trump sign an executive order with you in the Oval Office.
Yes.
And talking about it at the time. Where does that stand right now? Because some people say, you know, if you're really going to try to build the wealth of the United States, you're better off cutting the deficit than borrowing money to put it in a sovereign wealth fund.
Yeah, I think the president decided that it's on pause while we work on everything else that we're doing now. So, and he said the other day that we'll probably spend more time paying down debt. You know, he is laser focused on paying down debt.
And you're prepared, if it doesn't go the way you want it to do other adjustments to make sure we are paying down the debt? Because some people are a little skeptical.
Well, again, David, let's talk about can you grow the denominator faster than the numerator? Like the reason we got here was, you know, think about taking out a home mortgage. It's fine if the value of your house is stable or growing faster than the debt. What's happened is, you know, that previous administrations took out a big mortgage. We didn't grow our way out of it. Now, I actually think that there is a chance that we can constrain the spending, up the growth, and that changes the trajectory. Because, you know, going back to this CBO scoring, which is alien to anything that makes sense, that if you cut taxes, they still score growth at 1.7, 1.8%. If we raise taxes, and if this tax bill didn't go through, it would be the biggest tax hike in history, then growth stays at 1.8%. So, you know, I think that we can accelerate growth here. So, you know, my worry would be that somehow you know, there is a glitch and the tax bill did not get passed soon enough. So, you know, I would encourage our colleagues in the Senate to push for the July date that Leader Thune has.
Last question. Growth is critical to your approach and the president's approach. What growth are we talking about? What are you projecting and when? Because right now we're not close to 3% growth.
Look, I think we can get to 3% pretty quickly.
Well, okay. How quickly is pretty quickly? Months, quarters, years?
Quarters.
In quarters, we'll be at 3%, you believe?
Yes.
Sustainable.
Yeah. Look, I think we were in the middle of, you know, as I talk to industry, this U.S. innovation edge, we are starting to see real productivity increases like no other country is. I think with the deregulation, with the certainty from taxes, and with this full expensing, which from 2018, 2019, going into COVID, for the industrial economy really gave it big impetus. So, you know, I'm expecting that by, you know, certainly by this time next year, we will be north of 3, and that we will be turning the corner toward the end of the year.
Every week seems to bring another story of a successful company losing its way. But what about those that don't? Or that, having strayed, find their way back to what made them great to begin with? We look at the Mars Company and Enel, two major global companies, and what they share in the way they do their business. This is a story about heritage, how a company's heritage can help it succeed, return it to success, or put it at risk when it is left behind.
Without an absolute reputation for safety and consistency, you simply can't compete. And that's why everybody's worried about Boeing.
Boeing is just the most recent and glaring example of a once great company stumbling, in its case by losing its core edge in engineering.
I'm an aerospace engineer, and back in the day, I actually worked for Boeing. That's where you went. If you wanted to work on airplanes, you couldn't go anyplace else. You really couldn't. That's not the case today.
Ron Epstein is a former Boeing engineer who now covers aerospace and defense for Bank of America. He watched as his former employer lost its way. It's far from the only one, but there are also companies that over many years kept their momentum or even regained it after a stumble or two.
IBM turns 114 this year, 114 in the technology industry. Think about companies that have lasted a century in the technology industry. They're hard to find because of the nature of technology.
Sam Palmisano spent much of his career at IBM, rising to become chairman and CEO. He attributes IBM's long-term success to a deep commitment to innovation.
The Watsons defined it was about the future and about innovation, and that's where you should drive. You should drive innovation.
Hello, class.
The business school at Yale University has created a program to study what separates the companies that succeed over the long term from those that don't. Some may find the results surprising. They take us back to that notion that has become known as stakeholder capitalism, although many of the CEOs don't find it new at all.
We've interviewed more than 175 chief executive officers as to the practice of this concept of stakeholder capitalism.
John Iwata spent 35 years at IBM, where he worked closely on innovation and strategy with Sam Palmisano. He is now an executive fellow at the Yale School of Management.
One of the things we learned in these interviews is that most of the CEOs felt this wasn't really a departure or anything new. And some of them said this is sound business practice, or it's a return to sound business practice, especially if you think about the long term, leading a corporation or an enterprise for the long term. There are short-term pressures or expectations that sometimes get in the way of making investments or decisions that may not pay off for many quarters or even years. So you have to think about that. You may think about non-financial commitments to employees, to society, and those are not standardized. Those are not accepted measurements and metrics, and so those are soft or squishy. And other factors that come into play here.
Iwata learned from his CEO interviews of the challenges leaders face in trying to bring together disparate parts of the company and disparate interested parties, and the key role of purpose in weaving it all together.
CEOs, like every executive, comes up through a business or through a professional career in a vertical, finance or R&D or sales. And when they get into the CEO chair, Satya Nadella of Microsoft said it some years ago in an interview, it's then you realize just how multi-constituent or how many stakeholders the enterprise actually has. You have shareholders, you have governments, of course you have customers and employees, you have suppliers, and you have to have these relationships with all of these constituents. The question is, do you manage them piecemeal, or do we think of this more holistically? A lot of the CEOs described, sometimes they use air quotes, this management system, almost an operating system for the company that is based on common definitions of the firm. Some of them say there are 3 questions that you have to ask and answer. Why, what, and how. Why do we exist, which turns into the purpose of the company? What do we do, which is the strategy of the company? And how, and that's the culture. How are we going to show up?
A well-known company that has put purpose and values at the core of its operations since its founding is the Mars Company, in business since 1911.
Mars is more than 100 years old, very successful for a long time. And as we began to talk to management at Mars and members of the Mars family, we learned that they were going through what we would refer to as a founding moment. And why? Because for much of Mars history, members of the Mars family led the company and worked in the company. But the reality today and in the future is very few members of the Mars family, perhaps no members of the Mars family, will be in management or even work in the company.
The principles and the values are at the heart of who we are.
Victoria Mars is the great-granddaughter of founder Frank C. Mars. She has been on the board for nearly 20 years, 3 of them as chair.
my grandfather had very strong principles and values. And these principles and values I grew up with without actually knowing that I was growing up with them. So when we talk about the Mars principles, we're really talking about the family values that have existed since the beginning. And as the company got larger, and it was more and more difficult for the family, specifically at that point my father and my uncle, to be around all the associates, to be able to talk about the values, and to be able to talk about how we do business, they decided it was time to write them down. The 5 principles that were actually written down and defined in the early 80s, quality, responsibility, efficiency, mutuality, and freedom, have been our principles since the beginning. And they are the foundation of everything we do within the business.
Times change and businesses evolve, something the Mars company has certainly done. But as much as the Mars principles may be updated every few years, the fundamentals do not change.
So they haven't changed, they've just been updated to be relevant. Management helps us and supports us and clearly, obviously, implements them in our business, but any changes to them, any tweaks to them, anything from the colors to the script to the words belongs to the family.
A company having principles is one thing. Putting them to use in everyday decisions, not to mention big strategic decisions, is something else entirely.
It's not a checklist, but it comes up in conversations when we make decisions. And I think there are 2 things. One, is this aligned with the purpose of what we're trying to deliver here, whether it is overall for Mars, the kind of company that we're trying to deliver today is well set up for the world we want tomorrow.
Klaus Aagaard is the Mars Chief Financial Officer and, like all members of management, not a member of the Mars family.
5 principles come up, certainly as a fact check, this doesn't feel like in line with the 5 principles. Well, why not? And and sometimes they're not all equal in every decision. Are we really delivering quality? Are we really directed by the consumer? Or is this mutual to the stakeholders around us when we may make decisions around renegotiating certain things or whatever? Are we true to the stakeholders around us?
The Mars principles underlie the values of the family, but the family also believes it makes the company more successful overall.
The principles and the values help us be proud of this company. We do believe that utilizing these principles helps our associates make the right decision. The decisions that create the concept of a win-win. We are all going to succeed together versus let me win and let me see you fail. So I really do believe that utilizing these principles has helped us be successful in business. It helps us recruit good people and keep good people. It helps us earn trust with governments. It helps us earn trust with our associates. It helps us earn trust with communities where we work. So to us, yes, it does make a difference and helps us be successful.
The Mars company is at its base a family company, a global, highly successful one, but nonetheless a family endeavor, which may give it advantages in pursuing its principle-based business strategy, but that can also come with some challenges.
There are no doubt many public companies with a long history that also has a very great story to tell. We believe we have our own story and our unique vision for the future, while respecting that long-term success is also built on continuing to have healthy short-term performance, if you want to call it that, is an ingredient that live well in our context with the way management is set up, with the commitment also of our owners to take a long-term view and leave a lot of capital for reinvestment in the company and set some objectives, both financial and non-financial objectives that really enables us to do the things that we're doing.
When people used to ask me and say, what is your biggest fear or what is your biggest worry? My response usually is, it's not the business. The business really can function very well on its own. It's managing a family. So Part of being able to be a family business, to continue to be a family business, requires a lot of energy and effort into working with the family. We have been having annual family meetings for over 20 years. Our family is continuously there because we're connected to this business. We're joined at the hip by this business. So having the family functioning well and having the family being able to manage through conflicts that come up, which of course will come up in every family, and being able to work towards a common outcome and common goals takes a lot of work.
The Mars family continues to work hard at pursuing the goals and values it has established since the beginning of the last century. But could a similar approach succeed in a publicly traded company in a very different business? And that's where we turn next, to the second biggest power company in the world, Enel, and how it moved forward by returning to its basic purpose. The Mars company has enjoyed a very long and successful history as a family company pursuing the family's values, even as it expanded around the world and into new businesses. But the Yale Project learned from its 175 CEO interviews that Mars shares some approaches with large, publicly traded companies in very different industries. One of them is the Italian power giant Enel, whose CEO redirected it for a new age by taking it back to its simple roots.
Headquartered in Italy as a global energy generation and transmission company, Francesco Starace became CEO, I think it was in 2014, and he inherited a company that was troubled, particularly from a stakeholder perspective. From an investor standpoint, the stock was languishing, the company was heavily in debt. They were in this chronic cycle of making massive capital investments in building new power plants that wouldn't come online in some cases for 10 years. And by the time the plant was operational, it was obsolete. And they had these big write-offs and so forth. So not good for the investor. At the other end, they had difficult community relationships all over the world. I think he said we were at war constantly with communities where we put plants in, they didn't want us there. And for 40 years or more, we had these difficult relationships with communities.
Like other CEOs looking to move their companies forward, Starace studied the future of his business, and like so many others, concluded it laid in technological changes in the very business of power.
The company was already pretty large. It was big. And it was heavily indebted because of the expansion we had in the preceding years. It had, let's say, a cash conversion problem. So there was a lot of revenues that didn't really come up with a lot of cash. And growth was a little bit stalling. It was a company that had to deal mostly with managing debt, given the size it had. The issue was we needed to restart growth, but more than that, we needed to, let's say, give clarity about the sustainability of future revenues to the debt markets. That in itself, the size of a debt is a function of the size of the revenues that you can generate to serve the debt. So there was a little bit of an issue at what was the future of the company going to be. So we had to actually decide what was the trajectory of the company, sell it to our shareholders and also to, of course, the whole market in a way that it was understandable, solid, robust enough to withstand potential shocks, and of course, more generative of cash flow, basically. That was the issue we had to deal with. And that clearly had to do with the time, and how much time did we have to do that, and also what kind of pockets of value creation we had in the company that we didn't really tap well enough.
As you determine the trajectory for growth and for revenue going forward, how did you find the trajectory that you settled upon?
Basically, we said, where is the technology going? Because you can ignore technology for a while, it's okay, but at the end of the day, it always catch up with you. So where is the utility sector and the industry that is with it? Where is it going and what forces are changing these technologies? And we saw at that time We had seen it before with Enel Green Power, I should say, that there was a major change in the technology of generating electricity, namely that renewables were becoming competitive, had become already by 2014 competitive with thermal generation by and large in many parts of the world. And we were not active enough in that space. And that space was going to be where value was going to be created in a major way in the next few years. So we said, how do we catch this train? How do we jump on it? And what can we do?
And was that driven by a revenue stream that you saw out there because of technological change?
I think the revolutionary thing about renewables at that time, the people didn't understand. I think we were maybe the first that understood it consciously and not unconsciously. You know, we actually got and studied and really came with the conclusion that shifting our generation from thermal generation to renewables, we would increase double the EBITDA margin, so the amount of money we would make with the same kilowatt hour. And that was a major aha moment, if you want. We said, okay, well, let's do it, because there's no time to be lost here. And to do that, we had to basically completely change our operating model at developing plans and at thinking about generation going forward.
For Starace, identifying renewables as the growth opportunity for Enel was the first step. But to get there with the growth it promised required the company to move fast, faster than it had ever done in the past.
Imagine this is an industry that worked before with a time horizon of 5 to 10 years. So you started investing in something, and that whatever it was, a power plant or anything else, it would start generating revenues 5 or 10 years after. And we said, we shortened that to 3-year maximum, okay? That was a major shock for most people, and those that were impacted were basically the development people, you know. And we said, scrap all the stuff that does not stay in this 3-year time horizon, and that accelerated a lot, you know, the circulation of the capital. I mean, capital started working a lot earlier than before, and that gave us the momentum we needed to really kickstart the whole thing. I should say it took 6 months to explain over and over more than one time this logic. But after that, everybody got it. And I would say in a few years, we were working at 2 years, not 3. So we further shortened that time. That was a major change.
After some initial resistance, Enel employees embraced the new direction because of the opportunities it presented them. But ironically, Starace sees this new direction as really a return to the basics of what gave rise to the company in the first place.
The pushback was basically a different one. It was the fact that we had, say, a very limited number of very large investments with which we thought we would continue to grow the company. And applying this 3 years rule, we would cut the investment size a lot. So the renewable energy projects had much smaller sizes. So people said, how can we grow? Because these projects are so small. And the answer we gave them is, well, you have to multiply the number of projects. So instead of having, say, 20 projects, you're going to have 200 or maybe 400. And that was a major shock, because to manage 200 or 300 projects at the same time was something a company had never done before. I think at the end it was exciting for people. They needed something, and they laughed at the fact that they could go at it numerous times, many more times than they ever dreamed.
And every corporation has a culture. Did the culture change under your leadership?
No, it did not. Actually, what happened is that we needed to declutter the cultural space in a way. So, you know, utilities have a very deep culture and very simple one. All of them, I mean, they're all the same. You know, the semantics are important. A utility is useful to people. That's why it exists. And most of the utilities were formed in the past to electrify a space that didn't have electricity. So people got pride in bringing light to places that didn't have it. That is the culture of a utility. A utility is useful to people. to people or businesses, but in any way to society. The rest of the stuff that over the decades were thrown at utilities is noise. So what we had to do is declutter all this noise, throw it away and say, guys, we are here for one very simple purpose or not. And everybody agreed to that. And that, I can tell you, was surprisingly identical across geographies. There was zero difference. From Russia to the US, from Latin America to Africa, including Europe, it was exactly the same feedback. Everybody said, that's us, exactly, we want this. So it was super easy. I just had to eliminate a lot of, say, substrata and stuff that were thrown at the utility over the years.
So in a sense, you were not fighting with your heritage, you were returning to it.
Exactly. We had to go back to it. You know, we had a purpose statement, and that was like 5 sentences glued together, and you can read through them who wanted to add something, and nobody said, no, it's too much. So it was a super complex stuff. And we just said, you know, this doesn't matter. What are we for here? I mean, we are useful to society. That's our purpose. So we created a very nice purpose line that was a sentence, open power. We empower sustainable progress. That's it. And everybody immediately identified in that. So we didn't really have to invent anything. We had to remove stuff.
The term stakeholder capitalism has become somewhat controversial, a potential distraction from the basics of running a for-profit business. But whether you're a global power like Enel, or a global family business like Mars, or the 140-year-old IBM, those who actually run the businesses find it to be pretty basic.
Most people running the companies understand that the way you create profitability, which funds your future investment, is through your innovation in your product lines, in your customer service, whatever it happens to be. That's how you do it. Now, quite honestly, David, because I am old and I am cynical, the CEO should have been doing this anyway. That's what a lot of us were just doing.
And even some of the most troubled businesses are embracing some form of this stakeholder capitalism, as the relatively new CEO of Boeing, Kelly Ortberg, recently told Congress.
Boeing made serious missteps in recent years, and it's unacceptable. In response, we've made sweeping changes to the people, processes, and overall structure of our company. While there's still work ahead, these profound changes are underpinned by deep commitment from all of us to the safety of our products and services.
Up next, Larry Summers takes us through Harvard's battle with the Trump administration. The Trump administration's battle with Harvard over funding and schools' policies is just the most conspicuous of a series of such clashes with prestigious American universities. Larry Summers has spent much of his career on the faculty at Harvard, where he served as president in the 1990s. He's not been shy about criticizing his school, but does not endorse the approach being taken by the government.
I think Harvard should carry through on a whole set of reform with respect to anti-Semitism, with respect to discipline of students, with respect to widening of perspective, with respect to ensuring compliance with the Supreme Court. And I think the government should recognize that and keep the regular flow of funding going when Harvard does move on reform. I think there's a risk on both sides. I want to make sure that Harvard does carry through with necessary reform, but gosh, we can't have the government ordering universities around in violation of all the processes that are prescribed by law.
That's a really important point. It's Harvard, but it's not only Harvard. Now Harvard has actually sued various agents of the U.S. government on the grounds that you were suggesting actually recently, that it was beyond the scope of the Constitution. How important is it for that case actually to make it through to a judgment for the sake of not just Harvard, but other universities?
I think it's important that a precedent be set, whether that precedent is set by a court or whether that precedent is set by the government backing off and moving to address its concerns, as previous administrations have, in a lawful way through communication, negotiation, prior notice, due process. The precedent can be set in multiple different ways, but this goes far beyond Harvard. This applies and is of relevance to universities across the country. And universities are one part of a broader point that the government is not allowed to selectively persecute its enemies. And what happens in universities is going to bear on what happens to law firms, is going to bear on what happens to companies, is going to bear on what happens to specific teachers and specific schools. This is not just about so-called intellectual life. This is about liberty and freedom and progress. Those ideas are under threat from what is happening. This is a different level, David, of challenge than certainly I've seen in my career. There have been presidents I passionately disagreed with, who I thought were pursuing policies that were severely misguided. But I have never seen a president whose actions I felt were subverting the character of American democracy. And that makes this an especially important moment. If Harvard, with its more than $50 billion endowment, with its network of people who have gone through its schools that include a large number of presidents, a large number of people in the Senate, half the Supreme Court. If Harvard cannot resist this kind of tyrannical encroachment, then I don't know who can. So I salute President Garber and the leadership he is providing. He is not a flamboyant figure, but he is a person of great character and determination. And I think anyone who underestimates him will be making a very, very serious mistake.
One of the things we're hearing from the president is possible changes with respect to how we collect our taxes. We've had a series of commissioners, as you know. I think we're up to maybe number 5 in 3 months now. There's various actions, including talk about withdrawing tax-free status from various people. There's been a sharing of information. How damaging is that potentially to the economy?
David, we've talked a lot about the authoritarian tendency and President Trump threatening the rule of law. That's certainly a major risk. But I think we're seeing something else. We're seeing raw incompetence. Raw incompetence as they send a hugely consequential letter to Harvard that reverberates around the world, and then they said it was made by mistake. Raw incompetence when an acting IRS commissioner is appointed by the President of the United States, and then it's oops the next day because the Treasury Secretary has been given a chance to weigh in, and the appointment is canceled. Raw incompetence when there's just flat-out violation of law, as with instructions that have been given to the IRS to intervene in specific tax matters, as with the 501c3 for Harvard. Raw incompetence, I think we will come to judge when we observe the consequences of tens of thousands of IRS enforcement personnel being let go, and it being done in a way where because of the incentive scheme, the most competent people, the people who can get the best jobs elsewhere, are the ones who are most likely to leave. I think we are threatening the basis of our tax system, which is based on voluntary compliance. And I think if we have a president who's completely delegitimizing government and who's taking away the capacity of the IRS to process tax returns, to audit when that's necessary, I think we'll see many more people take cash payments and not report them. Many more people engage in dubious transactions with their cronies to misvalue assets and avoid paying taxes. Many more people engage in abusive tax shelters. That's an area the president, I think, has some awareness of from his past business dealings. And when all of that happens, the people who are going to pay are honest taxpayers. I'm working on this pretty carefully right now with some colleagues. I'd be surprised if we're not on a path to sacrificing more than $1 trillion of revenue over the next decade because of this misguided, wanton attack on the IRS. And that's going to make our fiscal problem worse, or it's going to force us into other kinds of damaging tax increases. It would be much better to do a better job of collecting the taxes that are levied under current law. It would be better not to be driving the economy from above ground to underground in terms of American competitiveness. So I don't think we've seen large consequences yet from all of this, but the risks are very big.
That does it for us here at Wall Street Week. I'm David Westin. This is Bloomberg. See you next week for more stories of capitalism.